You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time to rock out with the option block. Hopefully your favorite bi-weekly source for options information. I don't really know of any others, so there you go. We're in a category, a class, all our own. My name is Mark Longo, like the man said, and hopefully you're enjoying the show. Maybe you're listening live via Mixlr, MIXLR, in which case you're joining us live every Monday, or in this case Thursday, noon Central, 1 p.m. Eastern, via the old Mixlr. If you don't know where to get that link by now, just follow us on social media. We put it out there all the time. Or you can follow us on Mixlr, and then you'll be notified the second we go live, not just with this, but all sorts of good stuff. A lot of interviews going through the studio these days with FIA and a bunch of other stuff happening, so you'll hit all those. A lot of crypto, if you're into that kind of stuff. So stay tuned for that, and of course, all the other programs. Get them on our website as well, or iTunes, all those good places. And of course, however you listen, hit us up. We do like to hear from you guys. Questions, comments, insights. Vote in our polls over there on social media. We do, yes indeed we do, like to hear from you guys. And joining me on the old program today, let's go around the horn. Let's start out in the sleepy hamlet known as St. Charles, where we are greeted once again by good old Uncle Mike Tussaw from St. Charles Wealth Management. Uncle Mike, how you doing, sir? I see some green on the screen, even though it's slight, so you must have a smile on your face today, sir.
Oh, for sure. And I'm just tooling away on my iPad and drinking a grande mocha latte. For some reason, I just had the urge to do that today. I don't know why. Some events or something. I don't know.
And I don't know why you'd want to do that either. I mean, I know you're just a fan of Apple technologies. That must be what it is. Just your general love for all things Apple. Nothing to do with any other pending events. Because we know there are none. Apple earnings were actually 2 weeks ago, correct?
Right. And the grande mocha latte, for some reason, I had the urge for that today, too.
Starbucks. Their earnings are tonight after the bell as well.
Somebody caught that. Thank you.
Wow.
I actually think what's interesting is we actually have 3 of the 10 biggest companies in the world reporting by the open after the bell and before the open tomorrow. You have Apple, Chevron, and ExxonMobil all within about a 12-hour period, which if you think that which vol is just going to, I think, be sucked out of the market at that point. People are talking about elections. I don't think we've got a premium because of elections. I think we've got a premium because earnings season has been a bit of a crapshoot and interest rates have been moving around. So we also have non-farm payrolls in the morning as well on Friday. So think about this.
I'm still stunned. First off, that is, of course, the voice of the Greasy Meatball, Mr. Mark Sebastian from OptionPit.com.
Hi, everybody.
And then secondly, I'm stunned that he cracked your code, Uncle Mike. How could he do that? How could he break through to the heart of your very impenetrable, opaque joke, sir?
I think Mark is smart. So if that should be his new marketing line for the option.
Mark is smart.
Mark is smart.
That may go against some sort of FINRA regulation or something along those lines. I don't know. And also joining us, since you guys mentioned all the names popping off after the bell, it seemed appropriate to welcome on the guy who's given us all the data that we talk about every week on the show when we're talking about earnings. Yes, he is Mr. Matt Amberson, the founder and principal over there at ORATS, a.k.a. Options Research and Technology Services. Yes, his business card is that long. Matt, welcome back onto the show. You know, it's been so long since you and I have talked. It seems strange.
Almost yesterday. And, you know, what's even more funny is I'm just catching up. I'm listening to Mark and Mike from the October 26th show of Option Block. So it's weird to be on and listening to you at the same time. So it's awful weird. And Mark, I wonder if you could I'm sitting in my fire truck. I'm a domestic producer of heavy equipment, and I just reported yesterday. Do you know who I am?
Mr. Meatball, that's for you. You're the
I'm going to say you're Caterpillar.
Close. Oshkosh. Huge winner. Big update for Oshkosh. I know it's an odd name, but you know,
Oshkosh Bagosh?
Oshkosh.
Bagosh.
Yeah, I'm not drinking a latte.
Have you ever been to Oshkosh, Matt? I have.
I've been near Oshkosh. I played in a volleyball tournament up that way. So
yeah, no, I've been to Oshkosh. I've been to Appleton. I've been to all your middling Wisconsin cities.
Green Bay.
Been to Green Bay, been to casino there.
Now we're
all of those. All of these places are close to a casino. That's why I've been there.
There you go. Before we offend any more of our gentle listeners to the north, let's keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, welcome to the trading block. You guys know the drill, the portion of the show where we break down what the heck is trading. Got a little bit of green on the screen. I emphasize a little bit, at least compared to recent moves. We're seeing, fractional percentage moves on the upside in most of the major indices, but getting a little bit longer, a little bit stronger as the day has gone on. We're seeing the S&P up about 0.75 percentage point now, when it was kind of barely north of unched not that long ago. So extending the gains to the upside again. Still not quite the 2% daily move that VIX was pricing in for a while there. So as a result, of course, we're seeing a little bit of a relaxation over there in the old volatility space. VIX cash, to put it mildly, off nearly two handles, or 1932, looking very good, getting a nice trend in to slide right into my prognostication level for volatility views come tomorrow. Still got a day, though, so we'll see. Nice day for another point or so to come out of that, and then it will be looking delicious. But let's start with our guest. Matt, I was even thinking today, you've been on enough now these days on the network for a while where you probably should have a nickname, yet it's not percolating up to me yet. So I'll have to put my nickname machine on that for you. A few have come to mind, but nothing. It's got to spring organically to me, in order for it to really stick. And so I'm mulling over that in my brain right now, but nothing's come up to me yet, sir. So
Matt, the key is you've got to say your own nickname so that Mark knows it. So my name came from me literally saying, people used to call me the Greasy Meatball in college. I was saying facetiously, Mark cracked up, and I became the Greasy Meatball.
Yes, that is that was your own doing. That was your own shame.
It really
there.
was.
Now, does anybody remember what made him want to say that?
I do not. Do you?
I do. I remember it, but the listeners never voted to want to hear that on the strategy block.
No. Then it stays here. We're not letting everybody know.
Nope, not until they vote for it on the strategy block.
And we'll put it in the next strategy block poll and let them vote. But Mr. Matt, things are going on. Things are moving and shaking. Let's start. Kind of give us your thoughts, your overview of what's catching your eye in the broad market sense, and then we'll come back in a minute and we'll go a deep dive into all things earnings, because I know that's kind of your baby as well. But we'll start right now. What's catching your eye, broad market, broad volatility speaking, sir?
Yeah, I was really interested in what Mark Sebastian was talking about last week about his indicators, and we have our indicators at ORATS, and like Mark, I'm still a little worried, or at least looking at our numbers. We have a short-term contango number, which is really the slope of the front months in S&P, and they're still pretty much in backwardation. So they're still worried out there. So I'm worried. Implied volatility, hit the IV percentile of 100, which is usually kind of a blow-off area. So we had some signals going like there could be a bottom in sight. So I'm still worried. I think there's going to be still it looks like a bunch of volatility around. It feels a little bit like we hit a bottom, with the big blow-offs in implied volatility. So that's where I'm sitting in the broader markets. And I agree that there are so many big earnings coming out. That's going to take a lot out of the market. Trump's talking nice with China about trade, so that could help, but that could also turn on a dime. So that's what I'm seeing in the broad market, Mark.
But Matt, there's nothing to worry about out there now because VVIX is below 100, so all concern is off the table. Granted, it's only a half a handle below 100 at 99.5, but we can all breathe a sigh of relief now, right? That because the volatility of volatility is back under 100.
No, I think that's a good thing to look at. The volatility is an important factor. We just measure it straight out and put that into our mixture. But that's come down a bit. The volatility of historical volatility has come down. The volatility of implied volatility has come down a little bit lately. But it's still, not quite to where, we would call it a calm market.
Matt didn't pick up on my heavy sarcasm there. 99.5, not too different from 100. So I don't know. The worry is still on, I think, in the large parts of the market, even though you're right. We have had a couple of days now where we've managed to not just ameliorate a sell-off, but actually sustain a rally, which for a while there didn't seem to be the case. We couldn't sustain a rally. We'd get a little bit of a rally, and then here come the bears again, and here come the bears again, and here come the bears again. At least for a couple of days now, the bulls have been managed to fight them off, whether this is the old proverbial dead cat bounce or whether this has some legs. It's kind of what we're going to break down here. Mr. Uncle Mike, you're our resident bull, our bull in residence, if you will. What's catching your eye out there? That should be on your business card. Bull in residence, the option book.
Bull in residence, and then try and attempting to help your portfolio be a bull in permanence. Maybe no, but
I don't know about that one. Stick with the bull in residence. I like that better.
Okay, got it. Anyway, or Mark is smart. I like that too, but maybe Mike is smart. Anyway, I like the thing that's really catching my eye right now is the shiny stuff in silver. Big move today. Whether or not that has to do with the actual tweet that Trump made, he made the tweet, I believe, probably around like 8:30, 9 o'clock this morning. So silver was actually up fairly significantly by then. But nonetheless, we are getting a pretty nice move in the silver. We might crack the 14 mark again in SLV. Pharmaceuticals are up. IBB is up 3% on the day. Apple is flat for Apple. It's up 82 cents on the day. So I have a lot going on with the earnings, of course, that are happening after the market today, which will be very exciting to watch as per usual. I really believe that I should say, with what Mark is saying, this is going to be very pivotal in terms of volatility. Yesterday, I sold a call on top of one of my short calls. I'm sorry, on top of one of my long calls in my SPY strategy. And so the short call itself was losing a little bit of money at the end of the day yesterday because I sold it at a higher point in the day from where I sold it. But today, with the market being higher from where I actually sold it, the short call is actually lower in value. So this is an example today of how Vega can beat Delta if need be. Now, granted, it's a garbage out of the money call with which I sold, but the point is that as an option trader, you really need to have an understanding of how all aspects of how the option moves as opposed to just calls go up, puts go down.
Yeah, Mike, that's actually the key. Today, the VIX the volatility is off more today on a day we're only up 20 points than it was on the day we went up 40 and the day we went up 30. Today is the first day where volatility appears to really be giving up the ghost. And your VIX is now back below the November future. I would point out, though, that the November future is still above December and January is above the stuff behind it. There's some seasonality in December that kind of screws with that part of the curve. But there is still, we're not all clear, but we're definitely getting the maybe things aren't as bad signal from the market. So I think that we're going to have a lot of resolution when I'm on Volatility Views tomorrow in terms of what's going to happen with the market. I think it could really, a lot of stuff will change then.
So when we're celebrating,
and to add to that real quick, here's another indicator that when we have a pullback like this in the marketplace, I typically don't get phone calls from clients that are worried just because of the fact that I have them hedged 8 ways from Sunday, and they know that if they call me, they're going to get a 45-minute explanation that's very detailed on what's going to happen, when it's going to happen, why it could happen with their position. So maybe that scares them away. I don't know. But I actually have gotten a couple of phone calls from clients that are just a little bit nervous right now, and usually I can't say that's a guaranteed indicator, but whenever I do get that, it's almost always been a buying opportunity.
Yeah, it's the veritable taxi driver or whatever asking about the market. I was starting to get a lot of that Friday and Monday. So yeah, I agree. I think that if you look at the way the last week played out, where volatility could really not get a huge bid while the market sold off, you could tell that really we were experiencing volatility exhaustion, as Andrew would say, and the market itself was finding its way to a bottom, and that it appears to have taken place on when we got that big rip higher after being down huge on Monday. Monday we gave up the ghost. They ripped things higher, and then we rallied. What I would point out about the last 2 days is that we didn't see end of day, the kind of what I would call end of day volatility. So Tuesday we went up 40 points. We did rally into the last half hour, but what we didn't see is then the quick sell-off with rally back. Kind of the same thing yesterday, right? We sold off a little bit in the close, but we didn't get some quick sell-off with quick rally back. So, the market has kind of stopped being at a point where these quick and crazy algos can jump in and push things around. Tuesday we bought a $900 million to sell market on close. It just didn't even blink. So like I said, I think money has moved in. I'll just be interested to see what we look like when we get to the 200-day moving average.
And Mark, honestly, I'm just glad you're able to make it on the show today. After I was a little concerned after you tweeted out that horrific picture of you after the markets did to you in October, sir. I didn't think you were going to make it on the show, so I'm glad to see you recovered and that you're able to chat with us. Speaking of the markets, and a lot of it's driven by earnings these days, outside of the errant Trump tweet or two. So I thought, who better to join us here on the show today to discuss all this stuff is the guy who gives us all that awesome data. Remember, you can find it all, theoptionsinsider.com. Just click on the ORATS results. There's a ton of them. Click on ORATS as the author. You'll see all of them up there. Type it into the search bar. Of course, you can always go to orats.com. That's ORATS.com to learn more about how they crunch all these numbers. So, Matt, as the keeper of the flame here, sir, I've allocated to you about 38 minutes for your earnings rundown. So have at it, sir. The show is yours.
Yeah. We talked about this a little bit on the advisor's option, and I heard you last week talking about it, but I'd like to get into a little bit. Apple's coming out, and so this is going to be a good example. What we've been seeing in this earnings season with the elevated market volatility, it's elevating also the straddles and the expected moves during earnings. So that's been really interesting to watch. But as those straddles have been elevated, they've been moving to those straddles, meaning even though the market is putting more juice into this earnings reporting period, we are seeing the additional moves to back those up. Apple, we're expecting, or at least this morning, we're expecting, 11 and change dollar move, and the past year moves were only $9 and change, and so that's a huge difference. And the past year was $10. So this market is not only juiced up from the market wide, but it's putting more into these straddles. And I should also mention that ORATS has a way that we isolate the 1 day move, and you do that by looking closely at where we think the volatility is going to fall to, and draw that kind of term structure. So, for example, we think that Apple is going to fall from like a 45% implied volatility in the November standard 11/16/2018 expiration. It's at 45 right now, but it's going to fall to 29. And then you do some math and you figure out that, well, the straddle is still going to be worth something afterwards. And then you look at how Apple generally moves around. What's that distribution look like? So, before I did the analysis, I kind of in my head said, what do I think the distribution of earnings is going to be? Is it going to be a bell-shaped curve? Is it going to be like a dumbbell-shaped curve with the logic that stocks either move really big upside or downside? The answer ended up being that stocks are in kind of a flatter, wider distribution, but there's still a lot in the middle, which was actually quite surprising to me. I thought it would be more of a dumbbell shape, binary event, but it's not. So that's one of the techniques that we use, is to estimate what the shape of the distribution is going to be, estimate what the market's thinking it's going to move, and then pricing what the value of the straddle is going to be after earnings, and then we then get a very good picture of what it is on earnings, and then we go further than to compare that analysis to what actually happens. And so we, every quarter, when the quarter's done, we go through the 1,000 or so stocks that meet our liquidity minimums, and we check out how well our estimates were versus what actually happened, and it's very close. So that's our procedure, and that's what we're trying to do. We're trying to tell investors, what the market is expecting. And right now, that $11 and change that we're getting from Apple is actually kind of interesting, because there's an expiration with only 1 day left, and that is slightly less. It's about 10 and change right now, but I think Apple's expectation has come down with the market volatility coming down. The report that we put out was now an hour old, and I think the straddle has come down that much. So in essence, what we're doing is I'm comparing the regular November expiration, what that straddle is, and in some of these liquid weekly options, you could then see what with one day to expiration is, and you could compare those, so we know that our math is right. So Apple, we think is going to be still a big mover, but for me, it looks like with this volatility coming in, and in the past year moves being so much different, 20% lower. I'd be surprised if it moves that much. That's just me talking, but that's the way I read these numbers. Like Mark Sebastian said, there's also going to be Chevron reporting. That moves a lot less. That's only $3 and change. They moved the past year at $3.70. So this is an interesting stock. That this volatility is actually lower in the earnings than we've seen before. Bob is coming out before the open on the 2nd tomorrow. We're expecting an $8.20 move. That's much higher than the past year moves of 470, and higher than last year's of or the last expected move of 720. So BABA is on trend with a lot of these other stocks that are pricing in bigger moves in this earnings cycle that has the added bump of the market volatility around us. Let's see, ABBV. They have a pretty nice move implied in $4.41 versus $3.12 last year. Let's see, FLR. They're coming out after the close tonight. $3.24 versus $2.33 last earnings. Almost all these down the line are higher than the last earnings. If you recall, mostly in that period, the volatility was quite low in the market. So, I think the general theme is reflected, like we said by Apple, is that these earnings are juiced up, but we're seeing the results. So we also put out an earnings results report, so that we put out what we think these stocks are going to move, and then we come out with how they actually moved, and then one of the very important strategies that is often overlooked is playing the volatility after the earnings announcement.
That's the way I like to do it.
Yeah,
Matt. I think there's a lot more edge in figuring out whether you want to buy or sell options immediately following earnings than there is in playing into them. Earnings themselves are kind of a crapshoot, but markets tend to really screw things up when they're right after an earnings announcement. They get way oversold or way overbought. I'm with you.
I think you're wise to say that. And as a matter of fact, we were on with John Cherry of Northern Trust, and he was echoing, so that makes three of us, Mark. And because what happens,
I like John, nice guy.
Yeah, he's a good guy. And he, what happens is the markets don't know where to price these, and there are there's so many algos out there that are good going into earnings, but I think they're still trying to figure out what happens after. I think one of the best ways to look at it is to look at what your expectations are. For example, tomorrow I mentioned that we think Apple's going to go from 45 down to 29. I would look at a discrepancy from 29 and to see whether I'd be a buyer or seller after the earnings announcement. And like you say, Mark, oftentimes they're quite different than what they're expecting X earnings going into that. So I think that's one of the pieces of the puzzle to look at what the expectations are the day before, and you have to have a pretty good method for doing that. And also I think that just the typical historical volatility is X earnings, where things usually fall. And we do back tests of these types of strategies as well. But I think that's a very important avenue to look at when you're analyzing strategies to use at earnings. Like you say, it is a crapshoot. The other bit of advice that I would say is you have to do, since it's such a crapshoot, and for just one, if you do many different earnings plays, you have to be ready, I think, to do many different earnings plays in order to kind of get your to get your statistics in your favor. As you know, from the casinos, I've been kicked out of a few casinos for counting cards, but that's a different conversation. Blackjack, you have to keep playing in order to get that little bit of edge. Yep. Same with earnings, I think. So I'm going to stop it there, and I got most of the points across. If you guys have any comments or questions,
that's the key there, right? If you do it over and over and over again, there might be some edge, but most people are not able to trade every single earnings announcement to take advantage of any edge there might be. They have to pick and choose. And most people stink at picking and choosing, or the ones they pick and choose are the ones that are really liquid, where there is no edge because they're efficient. So, because they're the most efficient, it's amazing. It's just amazing.
That brings up a good point. So one of the things that we do as well is in our premium package is we say whether we think it's under or overvalued. And what we're doing is the way that we're looking at that is we look at the first of all, the implied volatility moving up or down, whereas the implied volatility versus historical. And, so maybe we have 10 different indicators, and we go and look back every quarter, and we have this report that we put up at the Option Insider on their blog that looks at these indicators, like what have been the best indicators. Generally, buying straddles versus selling straddles, it's about a 40% winner to buy and a 60% winner to sell. So so most people are pricing in that kind of additional risk. So it looks like people are hedging out their risks during earnings, kind of overpaying for the straddle. So that's one wind in your sails if you're a buyer.
But the one thing I would say about buying versus selling is, I found that when buying works, it tends to work a lot, like really well, when it does work, and when it doesn't, you lose some. Whereas selling tends to, more consistently wins, but when it loses a ton. And so, there's a difference there's a big difference between odds of winning and expected return. And I think that if traders really spend some time, they would find there are better trades than earnings trades to get a good expected return.
Matt, you think you hit on most of my questions here. The questions we get a lot, which you kind of already touched on. One are, is there a go-to surefire earnings trade strategy? Is it long premium? Is it short premium, et cetera? I think we kind of hit on that already multiple times, even on yesterday's show as well, that there kind of isn't. Earnings still a crapshoot. As you said before, the opportunities exist in the run-up, or even more importantly, as that's what I like to talk about Matt's reports a lot, is in the post-earnings kind of vol crush and what happens there. There's actually a lot of opportunities there that usually go unheralded, unremarked, because people are so focused on the event itself. The other one was some surprises. I think you touched on a few of those as well. If there are any other surprises you want to hit us on really quick, we can hit on those. And then B, I'll be nice to our listeners. They're hitting us up with all sorts of requests. The listeners, Matt, they want more. You give them a ton, they always want more. In this case, we have people asking for different tickers, including we got Shane here. He wants to know, what about Caesars Entertainment? Have you done any research on them? I looked them up. I don't think they're till the 7th, so maybe you haven't done that report yet, Matt. But if you have any insight you want to throw that way as well, feel free, sir.
Yeah, so I want to echo what Mark was saying too. When we do, when we go back and look at all of the earnings, like 1,000 stocks, and we'll look at every type of signal that we could have used. For example, some people like to look at the same quarter last year and think that's a good predictor of this year. That's actually a pretty poor one. We actually do the opposite. We think that the market prices too much of the same quarter's effect in, and that really doesn't have much to do with what's going on. At least our numbers say that. And like I said, we have some other 8 historical volatility, implied volatility in the days running up to earnings that we found to be important. But like Mark was saying, you have to do a lot of trades. Like we're talking about, the long on the long side, we're only winning at 46% of the time, so less than 50-50, but the wins are bigger, and so that actually gives us a positive return. And then the opposite, we're finding that our indicators are about 65% winners on the sells, and but we are getting a bigger return. On Caesars, we typically look out on our earnings report. We typically look out 1 week, and so let's see, what are we on? Oh yeah, so the Caesars should be in there on our earnings report. Let me take a look at it, Mark, and then I'll get back to you on. Sure,
we'll do a late. We'll put that into the mail block because that's kind of like a listener request anyway. So listener out there, I think it was Shane. Stay tuned. We'll get to you. See, we're nice here on the show. Sometimes you ask questions, and we'll get to them even earlier here in the show. Meanwhile, though, we'll do a real abbreviated version because we've been having a lot of earnings fun here. We'll do a quick abbreviated version of the odd block, then we'll get to a lot more of your questions.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. Welcome to the Odd Block. You guys know the drill. You know what it is. So let's get to it. Let's kick things off here. Let's dive into our old friend who's been rocking and rolling of late. Yes, Tesla up another 9 handles today, or nearly 3%, pushing 346 and change right now. That's, if you're paying attention, that's about 100 handles north of where it was about a week ago. So this thing all over the place, as they are wont to do. I was talking to people last night during trick-or-treating who are still into the Tesla premium harvesting, shall we say, and loving life right now, even though things are whipsawing all over the place. They tend to lean downside, so all those puts they sold for juicy levels, at least this time, are working out. You know, we all know it could easily break down through the 300 handle again and even threaten 250 and below. Yet that hasn't dissuaded the diehards of the premium harvesters out there in Tesla land. Let's see if all this price action has dissuaded our friends out there in the far, far downside puts in Tesla as well, as I wrestle with this new Live Vol X platform, which is nice and very function-filled and feature-rich. I like it. But they forced me to switch right before the show, and now I don't have my whole setup like I normally do, so I can't find all my stuff as quickly as I can, which is a long way around for me to vamp a little bit until I could scroll all the way down here. It's going to take a little bit to my Tesla downside puts. But spoiler alert, yeah, they are trading it up to. Let's start with our friends, the Par Puts listeners. They're trading out there in Jan. 1,600 hitting the tape today. These things are trading for right around 75 cents right now. OI is... unfortunately, under this new settings, I don't have the OI, which is a useful category to have. Here we go. 50,000 and change here open on that strike. Let's go down a little bit longer to a little bit farther out to the put that started it all, the Jan 50 puts here. 4,200 of these bad boys hitting the tape. Yes, that's 4,236, including a big block of 4,000, crushing the bid for 18 cents. So maybe someone getting the heck out of Dodge here, maybe deciding this upside move is for real, closing out. Either way, there's still a ton of OI, even if this is all closing. There's 74,000 change open on the strike. You're still talking 70,000 and change open on the strike if they are indeed all closing today. Let's go down a little bit further. People like to play in the crazy puts here as well, and that of course is not coming up. So let's just move on here to Jan really quickly, if I can get them quickly. There we go. Jan 2020, yet again one of our favorites, where also we've seen just a ton of downside action out here, but usually it's a little bit more muted than what we see in the regular Jan, of course. 200 about of the 2020 100 puts hitting the tape today. Open interest about 28,000 there. The 50 is not that active, only 20, but a $1.20 of the 40s and a $1.20, $1.12 of the 10 puts going up out there. Size OI on all those strikes as well. Let's dive in really quickly. Let's go over to our friends. Let's go to our friend, the Flowmaster. Fire up his machine over there as well, for courtesy of Trade Alert, where they built that cool little Insta scanner for us. So if we're doing a show like this, we can just hit a button, and it brings up some good stuff, including I don't think we've talked about, at least not in a while here on the show, our old friends here, Yelp. You guys know Yelp. They're trading right now. Again, I'm still getting used to this new live vol interface here, so bear with me for a second, listeners. Trading right around $44, up about $1.15, or nearly 3%. This is the name that averages, well, they're showing me stock averages, which is not what I need right now. Let's see, option, there we go. Average volume out here in Yelp, about 9,200 contracts a day. Today hitting 43,000 on the old tape, including out here in the Nove time frame, where if we scroll down a little bit, on this, still giving me all the months, all the strikes here. we got the Nove 29 puts lighting up the tape, listeners, to the tune of 28,500 going up in one block here for hitting the bid for an eighth, 12.5 cents. The old time numbers here. They were pretty much a dime bid coming out at 65. So looks like paper's selling. Worth noting, this is all opening, only 25 contracts open on that strike right now. As the day has gone on, another 12,000 or so hitting the tape. Total of 40,500 lighting it up out here on these puts. That dime bid, as you might imagine, gone. They're a nickel bid at 14 now. Go figure. So size paper here. Let's pull up a really quick chart here as well, if I can figure out how to do this. Here we go. A year ago, it was trading 47 and a quarter, so a little bit north of where it is. Got as high as... this looks like in the low 50s back in September of this year, not too long ago. Now kind of dropping down a little bit here. So it seems like this is straight up line in the sand, eighth harvesting 40,000 times. Mr. Meatball, I know this is your favorite strategy, picking up an eighth 40,000 times. This is what you do at Carmeline all the time. What do you think about these opening, apparently line in the sand puts here for size in Yelp? Oh, Mr. Meatball, have you fallen off your stool again, sir? Have you had too many beverages?
How can I lose with that trade, right?
How can you?
There's no risk. It's highly efficient. Lots of money to be made on that one. Love it.
That's why it's the go-to. That's why I always say Carmen line. The
that
eighth,
actually was us.
The eighth, I don't mean to talk out of school here. I don't want to reveal your trades to the world. But, you know, they call you the eighth picker-upper for a reason. And sometimes you'll get onto a teeny. These are old school fractions I'm throwing out here. No one knows what the hell I'm talking about. Instead, we could do more in the odd block. I want to get some of you guys, too. It is Thursday, after all. So let's keep on rolling into some fun mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, before we get to your questions, listeners, we'll get to one of your questions you already asked. Matt, I bought you some time here, sir. If you have any, first off, if you have any thoughts on our odd block friend there, those crazy out-of-the-money puts, have at it out there in Yelp. And then B, if our listener request, if, listeners ask, and we're nice, we help them here on the show. If you have any thoughts on the request for Caesar Entertainment, sir, have at it.
Yeah, Yelp is bucking the trend. Yelp's coming out on the 8th after the close. And their estimated earnings move is actually less than the last estimated move and less than the past year move. So something's going on in Yelp that's deadening the volatility, and I think that trade may reflect that. Yeah, as far as Caesars go, we looked at that. It's a low price stock. I think they're awful tough to, $8 and change last, and down from where it was. I think those are difficult to play. Mark, I'd look to you to see what you do on those those lower price stocks around earnings. But I have difficulty, knowing what to pay, and it seems like it's less predictable. With those lower price stocks, the last move that they had was a very large one, and we had a couple of our indicators pick it up, meaning we're predicting a big move for our last Caesars report, but again, I shy away from the under $10 around earnings. I don't know about you guys, Mark.
You've been channeling the Viceroy here, our old friend Alec Jacobson, who used to just turn his nose up at anything south of $10, let alone $5. $5 was just anathema to him. He could not process it on the show. Speaking of processing here, let's process some of your queries, some of ours as well. We asked you guys at the beginning of the week, hey, vol, all over the place. Not telling you anything you don't know right now. Some of you guys saying, it's too cheap. Others saying it's too expensive. That's what makes a market, right? Either way, you guys all want to trade it. So we asked you kind of an update of one of our rolling questions we ask you guys usually a couple of times a year, which is, what is your weapon of choice when you're out there slinging yourself some volatility? Gave you 4 fun choices. First off, the old go-to, the old standby VIX options and or futures. Or you can go a little bit removed to go to the ETP space with VXX options, or the underlying there. Or you can get more removed and a little bit dark side there with TVIX. No options obviously there, but I know a few of you like a TVIX there. And it's one of the last of the Mohegans out there in that space that didn't get wiped out after February, so they kind of win that space by default. Or you can go the more direct route which is the SPX/SPY type volatility slinging. And I won't make you guys guess because we got to keep rolling with some cues here. But 52% right now. Speaking to the sophistication of our audience, I like this. 52% saying they go the direct route. They go SPX or maybe some SPY options. VIX a distant second, only 27%. 14% go on the VXX route, and a meager 7% going in for the old TVIX, which is the way it should be. I've never been a huge TVIX devotee, shall we say. All right, let's move on to some other questions here. We got Banff. I like that handle, Banff. He says, I was looking at this list of stocks with the highest institutional ownership. It's kind of surprising, at least to him, he says. What effect, if any, does large institutional ownership have on the options in these names? And he included this list for our reading pleasure. I'll just run it down really quick, listeners. Number 1, Bank of America. Number 2, good old Softy. Number 3, GE. Number 4, Pfizer. Number 5, Comcast USA. Number 6, Wells Fargo. Number 7, Costco there. Oh, sorry, Cisco. Number 7 is good old telephone. Number 9, my old stomping grounds, Intel. Number 10, Appel, a.k.a. Apple. Number 11, Mr. Buffett's favorite, Coke. And number 12, Verizon. Verizon being on there is kind of interesting. But yeah, it's an interesting list. I think the names out there, I don't think really surprise a lot of people. Maybe where they fall on the list is a little bit more surprising. But this is the kind of thing, you have big funds playing in these names. They have certain impacts. We used to see it all the time, especially when I moved out to Intel. It was kind of interesting to me to see, because Intel at the time, back in the go-go.com world of the 90s, was in every large fund. And the institutional paper would come in. And it was more liquid as a result, which is nice. When institutional players come in, usually it's a liquid name. But B, they did one thing over and over again. Guess what that was? They wrote calls and they bought puts. So the skew reflected that every month. And every time a new series was listed, you had to get ahead of that. You had to sell your calls and you had to buy your puts quickly with anybody you could before the funds came in. And they tweaked that skew all to high heaven and got it all lined up again. So it was fun. Let's put it that way. Let's go around the horn. Uncle Mike, we'll start with you if you have any thoughts here on for Banff. He wants to know what any effect large institutional ownership has on options trading in particular. You like some big names. You trade them in Strategic Night. Any impact you see there?
It could be. We don't really look at that so much, but we look more of like theoretically, we believe buyers could be coming in based on this event or that event. But in terms of actually looking at specifically where the large institutional ownership is, something that we really don't use that much as an indicator. But I think it's one that it could be. It's just a different game with which we don't play that specific game, if that makes sense.
That does not make sense, and I'm booting you from the show forever.
Then I quit.
Mr. Keeper of the ORAT's Flames, sir, anything to add here on institutions and their impact on options flow?
Yeah, so one of the things that we look at is the component volatilities versus the ETF volatilities. And, as these bigger institutions are coming into these names, the correlations go up, and as the correlations go up, on these names, the volatility sometimes subsides. So that's I just look at those correlations going up more when those institutions are, and that's what we're seeing in our numbers on our side, Mark.
All right, the rest of our questions are all pretty epic, so I'll see if I can squeeze in one more epic mega one here. This comes from Mark. Good name, Mark Davis. He says, hello. Well, hello, Mark. Says he's written in previously and got some great feedback on his question. Well, happy to help. So he says, I'm hoping you can help me out again. I am still playing, and he puts paper trading here in parentheses, with options, while in my real account, I purchase shares outright. After having quite a few good years with the increase in volatility lately, I've taken some pretty rough hits. So far, year to date, I've lost about 16% in my portfolio. I should also mention I only currently deal with index funds, S&P, and some small cap. I go in and out of these stocks based on various parameters that may have me holding a certain stock for less than a month to a little more than a month. So short time horizon here. He goes on to write saying, is a stock replacement strategy a good use for this, or maybe not, since the time horizon is generally not long? He gives us an example here. Tomorrow, I may buy 100 shares of SPY at $25 each. Good price. likely selling the shares in about 20 days. I am trying to figure out a way to get the same or close to the same movement as if I owned the shares outright, while limiting the downside of at least setting a line in the sand. Oh, he's listening to the show. He's quoting the Rock Lobster. I'm having trouble wrapping my head around the right strategy, or if what I want to do is even possible. So he goes on to say, in the example above, my portfolio had bought outright and set the stock is at 30 in 20 days. I'm at $500. But what do I do to get close to this using options? On the flip side, if SPY was at 20, I'm thinking, is there a way that I can protect myself from losing some of that 500 if I'm doing that? Also, he asks, I'm not sure when I'm doing this, should I only be buying enough contracts that I could afford it were I to exercise the options? I.e., if I have $200 in my account and the underlying is $1 a share, would I only want to buy 2 calls, even though I would ideally have enough money to buy more contracts? Thanks for your feedback. Well, a lot of questions in here. A leverage question, also the suitability of stock replacement on a shorter term time horizon, a weekly to the outside a month. That's interesting. Yeah, you're right. Not the typical use case we talk about or see for stock replacement. Stock replacement is usually, as it implies, a replacement for stock. And usually that's a little bit of a longer term time horizon. Most people I know who play in the stock replacement game usually go at least 3 months out, probably 6 months to a year in that time frame. They usually go, it depends on the person, somewhere around a 60+ delta, I think, 60 to 80 delta range. 80 is a little high, maybe 60 to 75 delta range, about 6 months to a year out. Seems to be that sweet spot for those. So in that case, obviously, your bang for your buck is going to be a little bit mitigated here when you're talking about near term, but it's still viable. Maybe let's go around the horn. I don't know, Mr. Meatball, you got anything for our friend, also named Mark, who wants to know about the suitability of stock replacement strategies for near-term, delta trades in the week or so time horizon, and then B, also should he be limiting himself if he's doing stock replacement to only the amount of stock he could buy? So he's thinking about maybe should he exercise these, which is interesting.
Why?
I don't know.
Why would you ever want to hold stock if you're trading an active trading
He's writing
strategy?
into the wrong show if he wants to hold stock.
Yeah, buying in the so. I run a strategy that strategically goes long stocks, but I never buy the stocks. I buy an in-the-money call, and then if I want to keep owning it, I roll it for a penny. I don't know why you would ever pay the rent on actually owning stock. It's such a waste of capital, unless you're trying to capture a dividend, but that's not his strategy. It sounds like he's running like strategic stock buy. Why? I have a webinar on YouTube called Options for Stock Traders. You should watch that, young man, Mark Davis.
Young man, perhaps old man. We don't know. We don't judge. But yeah, if you're definitely on the exercise front, if you're exercising, you're kind of getting rid of all the benefits of doing the stock replacement to begin with. You're replacing stock with options for a reason. A lot of that is capital efficiency. You also have the Greeks working in your favor and not against you. You get rid of all of that if you swap in for the stock, and also the leverage component. So yeah, definitely don't do that. The first part of your question is a little bit more debatable and discussable. Mr. Uncle Mike, you've been known to do a stock replacement or two in your day, even though I know it's not your go-to. If you do, what's your usual time horizon? I'm guessing it's longer than a week. And then what are your thoughts on using stock replacement in the shorter time horizon type trade?
Yeah, short term, I don't think there's any reason to ever own a stock if you know you're going to trade short term. Even if you're trying to capture a dividend, I think you're better off just if you're being short term. It's just not worth it to me unless there's exceptions to everything, and we can go through some of the exceptions of it. But for the most part, 99% of the time, options are a better way to go, in my opinion, if you're a short term guy. In terms of the stock replacement, in my SPY strategy, I am always constantly trying to find out what is the most efficient and best way to be bullish on SPY, whether I'm buying premium, selling premium, whatever the case may be. I think you need to be flexible if you're trying to do some type of stock replacement. If premiums are super high, then you need to do a spread of some sort. If premiums are super low, and what is high, what is low, that has to be your own opinion, then maybe do some premium buying. So I think that if you're looking to do some type of a stock replacement, you need to be flexible in what you want to do, because sometimes it's more beneficial than others to do different things.
Mr. Matt, take us home for us, sir, on this epic question about the nuances of stock replacement.
Well, I've had some strategies go south over my trading career. I'm sure we all have. If you're losing 16%, it might be time to change the strategy quite a bit in your indicators. Now, I totally agree. But a lot of people do hold stocks longer term. Obviously a long-term capital gain and getting dividends. So, let's just say you do have the stock and you have some reason to own the stock. What backtests well is a very far out of the money put or two, and then selling some shorter term put spread, for example, and maybe even a call spread. So to try to get some income around that, and listen to Mark Sebastian's podcast. That's in Mr. Tucson. That you're getting a lot of good advice here. So change it up. Listen to some podcasts and get some strategy help and see if the next strategy works better than this one.
If you want the guy also who talks a lot of stock replacement on our network here, check out Options Playbook Radio. Brian does. He calls it the fig leaf, where he does a little bit longer term call, and then he goes out and he writes the near terms, the weeklies and monthlies against that. So it's a way to find, again, a little bit different strategy than what you're talking about here. But if you want to talk stock replacement, check out all the archive episodes of Options Playbook Radio, because there's a ton of it in there. Meanwhile, we got to keep on rolling. It's time for our final segment, indeed our last segment. Let's just do a combo, because we're kind of up against it. It's time for a combo around the block / sad face saying goodbye block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, there we go. There's the music. So unfortunately, listeners, we got to kind of leave it there. But before we do that, let's go around the horn. Let's start with our guest. Matt, first off, tell us what you're watching for the rest of this week, and then B, if listeners are intrigued, and I'm sure they are, they want to learn more about all your ORATS reports, maybe check out some of the premium offerings, your back tests, where should they go, what should they do, sir?
Yeah, like we discussed, I'm liking to see what's happening to volatility after earnings. So what you could do is get the report up there on the Option Insider blog and look at the implied volatility now and the implied volatility expected after earnings, and start to look at where the implied volatility comes in after the earnings are announced. I think that's an interesting strategy. Mr. Sebastian looks at it as well. It's a good one. That's what we're looking at. And we're also doing quite a few technical indicators now. We're looking at the market. When is it going to, we're still worried about it. Listen to Mark Sebastian's indications on the market. He's still worried about it. When are we going to come out of this? We're not near the end yet. It's just we're starting to creep in. We still have some backwardation in the SPY regular volatility. So that's what we're looking at, Mark.
All this meatball love here on the show. I don't know if I can handle this. Let's instead go to Uncle Mike Tucson. Uncle Mike, sir, what are you watching for the rest of the week, and what is cooking in the land of St. Charles Wealth Management, sir?
Got it. Well, I am watching the earnings later today, like we all are, on Farm. Just a lot of things, and as well as the president's Twitter account, and seeing what's going on with China. In terms of what is going on, if your financial advisor is someone who, when you ask him what's going on with this market right now, and he goes, I don't know, come see me. I am actually having at our Option Club in St. Charles Wealth Management, come to my office at 303 East Main, November 15th at 7 p.m. The Option Club topic for the night is, so what do I do now?
Oh, nice. Thanks for the invite.
And the greasy meatball, apparently he might be there.
Why not?
Mark's bringing
There's
the
nothing
Euros.
I love more than St. Charles at 7 at night.
Except
Absolutely.
St. Charles at 7 at night with some delicious Skippy's, Euros, and lemonade, sir, which sounds like you're providing to the Option Club. Very nice of you. Mr. Meatball, when we're not getting free Euros and lemonade for you, what are you watching and what's cooking in the land of the pit?
Same thing as Matt. I'm watching what happens with Vol and VIX futures here. I'm very interested in kind of what the rest of the day looks like. And yeah, tonight at 8:30 Eastern, 7:30 Central, 6:30 Mountain, 5:30 Pacific, I'm doing a webinar on weekly and daily option trading. Go to optionpit.com/weekly to get yourself registered.
There you go. You heard the man. optionpit.com/weekly for some more info later on about all things weekly options. Speaking of later on, if you're listening live, you're joining us now, you're intrigued by the things we're talking about in the land of equities, but you also maybe like yourselves some commodities like Uncle Mike was talking about earlier, as well as all kinds of fun in the volatility space, skew and everything else like that for crude, for gold, for equities, for all of the above, maybe even a little crypto. Join us in about half an hour for TWIFO This Week in Futures Options. It'll be me, it'll be friends at CME Group, it'll be friends at Quick Strike, friends at FTSE Russell, and indeed special guests from TD Ameritrade as well. So a lot of people joining us. Going to be a crowded show, but it should be a fun one. So join us in about half an hour for that. Otherwise, we'll see you next week for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.